Today, I'm going to start with the macroeconomic environment, then followed by a few details of the fixed income market, credit market, equity market, then intermarket, and then bring it all together and give my opinion on where I think things are going to go, but also some tools that I've been using or have used for a long time to help me not only invest, but also to trade during the day and use some of these relationships, which I'll get to in a later part of the segment, use some of these relationships to make effective investment decisions, but also trading decisions. So what we see here is GDP and unemployment. And if you've been looking at the news recently, what you probably heard is the Fed has enough ammunition to go full steam with its continued plan to increase interest rates into next year. Why would people think that? Well, the answer lies in the relationship between unemployment and the real gross domestic product. And if we look here, what is considered the natural rate of unemployment, around 4 to 5%, we're nowhere near that. So the Fed has what is called a decent amount of slack between the 3.7 unemployment rate and the natural rate of unemployment, which is around 4.5%. And so, as you can see, if you did an average, you could kind of get to that. But the economic term, which I will show here, I had that prepared for you guys, the natural non-accelerating inflation rate of unemployment is the lowest unemployment rate that can be sustained without causing wage growth and inflation to rise at the same time. So that is what the Fed is trying to accomplish. And so I brought this up because I thought it was interesting because everybody's laser focused on this for good reason, because that's the number that the Fed is looking at. But what you see is, you see GDP right here, GDP at 5.5 in Q2 of last year, and then unemployment at 4.6, and then it keeps going down, keeps going down. So now where we are as of the most recent GDP print, we have 1.9, well, that's April, but 1.7, I'm sorry, for GDP, and then 3.6 as of April for unemployment. The most recent unemployment rate is 3.7 as of August. And so that just illustrates that we still have room both on the GDP side to slow down, but we also have enough slack in the unemployment rate for the Fed to continue raising rates. Well, what does all that mean? That means to me that GDP is going to slow down. We haven't even got to the point where we're going to be negative GDP. And as you can see, we've had recessions where we've had a slowdown in GDP, but it not be actually negative. The times where we've had negative GDP were in crisis times, as illustrated by the global financial crisis, the COVID crisis, and even in the dot-com bubble, we still didn't really go negative. But if you notice, though, if you go back further, what you see is you do see negative situations where non-crisis here, but inflationary situations, so 1980 and 1970. So from that perspective, if you look back at each one of these, what is most common? What sticks out the most? Inflation that is excluding crisis. So if you were to ask me, where will we be? This is before I get to the other pieces. Just looking at this, I would say we're gonna have a slowdown. Unemployment has to get above a certain level for it to make, what the Fed's doing to make a material difference or have a material impact on GDP. just by the sheer fact that we have inflation significantly above the natural inflation rate. And so we're out of balance on both the natural unemployment rate and the natural inflation rate. So that's first. Let's move to our next path here. And so usually when I'm looking at all these things, I know I'm going through like so many different things here with the economic trends, but I'll bring up this cheat sheet here and we'll go through some of the big macro stuff in a second. So we're gonna go through this next, this, and then this. This didn't come out yet. This comes out at the end of the month, but durable goods were increasing as of last month. So it's flat to increasing. It's kind of a mixed signal. So it's still sending bullish signals right now. And the economy is relatively strong. And so I only brought this up because I'm going to jump to the economic calendar in a second. But we had non-farm payrolls this week, continuing initial job claims and then continuing claims. Now, this week, and I'm gonna flip over to the economic calendar, but these are some of the leading indicators. And so initial jobless claims, they came in slightly lower, and that's bullish. So when you look at it on balance, the market will continue to go down until the economy gets soft. Right now, we haven't hit that tipping point to where we're soft enough for the Fed to take its foot off the brake. So jobless claims, what does that mean? That just means that people that are unemployed that would potentially file for unemployment are not doing that because people are working. And actual initial jobless claims, I think, were either decreasing or I mean, they're flat to decreasing, but the rate at which they're decreasing is starting to actually go up, which is interesting. Continuing jobless claims actually went down too. Continuing jobless claims, that's more of a leading indicator as we start to flow into what will potentially be a recession going into the latter half of this year, early next year, because what that indicates is people that already filed for unemployment continue to file unemployment because they haven't found a job yet. And that is when you can start seeing the unemployment rate go up more aggressively, but that hasn't happened yet. It hasn't accelerated. And so those are the key economic indicators that we've received this week, news that we received this week. Again, it's mixed. It's not enough for the Fed to be like, oh, yeah, the economy is getting soft. We're gonna take the brakes off. I'm gonna put our foot on the brakes. So no. And so that is reflected. If you look at these, I usually look at all of them for various reasons, but if you look at the investing.com with the economic calendar, I'm pretty sure you guys can, I just look at all of them. Like I said, I look at all of them. You can filter out the noise, but job openings, that's up slightly, but not a lot. It's flat compared to the prior month, relatively flat, but it's above estimates. Crude oil inventories, that's down. Depending on how you look at it, that's could be bullish if you're an oil trader because inventories are down. That means prices likely go up. And so that's something to consider there. Also impacts inflation. Non-farm payrolls, those were down, but not down enough to make it significant for any big change in Fed policy. And if any of you guys look at these, the important ones are the ones with 3 stars. But like I said, I like to look at all of them. If you don't have time and you're in a pinch, if you ever use this website, it's pretty cool. You can hit filters here, filter out what you need, and go from there. Drop those 3 stars in there, get rid of some of the noise. and boom. But like I said, if I'm in a rush or if I'm trying to make a decision on what's most impactful for that day that may impact me on the open or midday, then I just do this. If I'm looking to make some sort of medium to long-term investment decision, then I will take this filter off and then I will digest all of the data to decide what I think those impacts are going to be for the longer term. And so here, if we look at ISM, it's still above 50. It actually, we look at the last print, get this worksheet over here. We look at the last ISM print right at 552.80. So that's the same one from August. But my apologies again. I think I said that at the top of the presentation, but nonetheless, it hasn't changed. It's still above 50, and that signals expansion. So nothing over here in these 3-star areas signal to me that there's softening. So I don't know if anybody remembers the Jackson Hole thing, but that's why the market went down significantly, because what happens is you have bond traders, and we talked about it in our last session, bond traders that try to price via the Fed fund rate futures what the Fed is going to do. We also have bond traders in the actual bond market that use various instruments along with treasuries to adjust market rates up or down. And so interest rates went down, Fed fund rate, the Fed funds futures started pricing in a smaller Fed funds cut, not cut, but increase in a subsequent cut next year. And Jay Powell basically said, no, that's not what's happening. The economy's strong, we still have room to run, and boom, the market tanked. And guess what? It's been tanking ever since then, because we keep getting data that confirms that the economy is not softening significantly enough to be impacted by interest rate increases. Now, you might ask, well, when is all of this going to show up? Well, it takes about a year for all of these things to cycle through. So I think we talked about that last time as well. The projection would be sometime around this time next year into 2024, where we will see a significant slowdown, and the Fed is hoping to have a quote unquote soft landing, but a slowdown in the economy such that higher interest rates will significantly impact consumer spending, business margins, revenue, and everything that is driven by general economic conditions. And so that's where we are. The economy's roaring along. It's nothing significant that would cause the Fed to stop what they're doing. So let's jump in on so this, I'll start here and I'll go through this as quickly as possible. Shouldn't take too long. This part is just kind of an overview of where the Fed is and where they are in terms of open market operations. The Fed funds rate, that's 2.33%. That can be reflected closely, not exactly with the 1-month Treasury bill. The next thing to take note of here is the reverse repo operations facility. That right there is still sitting at $2 trillion. It's down slightly. What that means is now that Treasury rates are starting to come up, the money market fund participants, or people that can't participate in the Fed funds because they're not banks, they use the reverse repo facility to park their excess liquidity. So we talked about M2 last time, which is the money supply. And so if you're a bank, then you can park excess reserves at the Fed. But if you're not a bank and you're, say, like a mutual fund company or some other institution and you have excess cash, you park your money in a reverse repo facility with the Fed. And so those dollars are starting to come off, meaning liquidity is starting to come out of the system on the short end. It's still 2 trillion, so it's still a long way to go on the front end, but it's starting to come off. I think it was 2.3 trillion last time we looked at this in June, I think. But it's starting to come off again. You know, that's going to take a while. So there's still more pain ahead under the hood. Let's flip down. We go down further and let's take a look at the Fed balance sheet. So we talked about the front end with the reverse repo, Fed funds rate, front end liquidity here. This is back end liquidity supporting the 5-year note, 10-year note, 30-year note, things of that nature. So the medium term to long end. And as you can see, the change from the prior week, $23 billion. So what's happening is that the Fed is letting its treasuries expire. They slowed down their buying rate. And as a result, they're buying less, number one, but number two, the existing holdings they have, they're not letting them roll over. They are letting them expire and mature and not putting that liquidity back into the market, which will generally push up rates on the medium to long end. And so we hadn't really seen a big impact on the yield curve, and it's still kind of inverted on the medium end to flat. But as the purchases with QT roll off, then we should see some continued upward pressure on medium to long-term rates. So that's that part. Based on what the Fed did, some of the sentiment shifted. I think we went through this last time. We'll see what happens. This was like 70% on the 50 side. Now is 40% and it's 50% on the 75 basis point side. So we'll see. There's still some more data to come out next week. So we have to, kind of monitor that and see where the Fed goes. But if you look, it's literally flipped. Like each day, the market has like some sort of schizophrenic attack, and the bond traders are like, oh, well, what are we gonna do? What are we gonna do? I don't know. Is the Fed gonna raise rates? Oh, let's sell bonds. And so they just sold bonds, and then boom, rates go up. They shot up, and then the likelihood of a 75 basis point increase increases. However, it decreased slightly today, which means, and that might be confusing to folks, it was confusing to me at first until I thought about it. I'm like, because we've been in this inflationary monitoring for so long, we're like, okay, well, we went from, let's look at the Fed, let's see what they're doing for inflation. Oh, by the way, now the bonds have repriced, now let's look over to earnings. But what we forgot, though, is that there is a point in which we've had 4 repeated days of sell-off. So at a certain point, you get what happens is a flight to safety. So although the bond market is still pricing in a 75 basis point rate hike, people were buying bonds today because there was a flight to safety and de-risking. So it was a risk-off situation that we experienced. So let me go back to this here. And so as you can see, that's sort of reflected here. So bond prices go up, interest rates go down. And so that's what we saw today. The yield curve still relatively flat. If you look at the belly of the yield curve, the 10-year is still lower than the 2-year, but not by much. Because the bond market, based on what Jay Powell said, knows it has to reprice. And so we'll probably see a flat yield curve for some time. Toward the end of the year, we might even see a little bit of this front end actually get around here to where we'll actually have a legit flat yield curve. I'm not sure if anybody's ever seen an inverted yield curve yet, but wow, when you see it, you will know it, and it will be a big deal. When I say inverted, I mean this being above the 2 year in 1 year. When it happens, it'll be bloody. So yeah, so let's jump over here. We kind of talked about some of the treasury stuff. This is M1, this is the M2, I'm sorry. This is the Fed's balance sheet, and it shows all of the money supply here, and it's starting to curl, meaning it's starting to come down, but it hasn't come down in a material way. I only said that because, you know, part of this discussion is, well, where is the market going? Well, we still have a long way to go. We have $4 trillion to come off of this balance sheet, and we're just getting started. So the market has significant downside. The rally that happened, as you can see, that's why we sold off so much in 4 days, and it took us a month. So think about that for a second. We rallied for a whole month and gave most of it back in 4 days. Why? It's right here. It's right here. And so we have much more pain to go. Personally, when we get those rallies, I realign, I sell off stuff I don't like, or that was underperforming or maybe not performing the way I thought it should, and then I readjust, rebalance. Here, this is one of those things that's sort of confusing, but hopefully it will make sense. So the Fed is not buying as many treasuries right now. They're stopping their bond purchases. They're still purchasing, but they're slowing down. This is a whole different thing. This is quarterly issuance of treasuries. Why am I showing you this? Why does this matter? You have two things happening. You have restrictive monetary policy, meaning the Fed is taking liquidity out of the system, increasing interest rates. That attracts capital to the US because we have the highest interest rates right now in the world for the best economy. So it's I think Brazil has a higher interest rate than us, Brazil and then Mexico, but their economy is not as strong and they're developing. So of the developed world, the US has the highest real interest rate. So that's attracting capital, which is pushing our interest rates up. However, the government is doing restrictive policy as well, meaning they're not spending money. And so when the government stops spending money, that means they are not selling bonds anymore. In order for the government to spend money, they need to issue bonds to fund government spending if they're spending more than what they're taking in revenue. So the government gets money by tax receipts, and that's how they spend money. If they spend money above the tax receipts that they bring in, they have to finance that. How do they finance that? They sell bonds. Well, if you look at this, they're selling less bonds. What does that mean? That the government has a restrictive fiscal policy right now. When you're selling less bonds, obviously you're not putting a bid in, so there's nothing to make bond prices go down and interest rates go up. So the combination of a restrictive monetary policy and a restrictive fiscal policy makes interest rates uncertain, which is why long rates have not popped yet. So when we see government spending sort of level off and then the Fed level off, we could see interest rates pop even more. And so that's just something to be aware of as well as we look at that. This is kind of like the yield curve for everything. We don't have to go through that per se, but just wanted to kind of get some insights. If you take the belly part of the curve, it's inverted on the future side. And so futures are having the 2-year note up at 3.7%. We're like 3.5 right now. So we'll see. We'll see. There's more to come. What I'm also looking at, and I mentioned this in an earlier session too one time, the spreads. So this is the spread of investment grade bonds above treasury. So the spread is like 150. It's been creeping up, but it hasn't gotten to recessionary highs or highs in normal periods prior to recession. So we still have a ways to go. Part of that is because rates have started to reprice, so people have been trying to reprice. But that's what I was saying earlier. Like when you're looking at portfolio management, you're trying to construct a portfolio that gives you a reasonable amount of return, risk-adjusted returns that doesn't blow your whole portfolio up. You want to have some bonds in there, but right now the spread of investment grade over treasuries is not worth investing right now, depending on your situation. For me, I think it makes sense to have as a part of the portfolio, but not a significant percentage. Just because when you take into consideration the inflation rate and you back that out, the return is actually negative. Same thing here with investment grade, so 5.8%. And so we'll look at that, and I have that over here so you can kind of see what I mean. Because I know talking about it is one thing, but seeing it, you're like, okay, well now I can actually understand what's going on. So here, the spread of high yield, meaning bonds rated below BBB, above the equivalent treasury yield is 5%. But if you're gonna buy a bond for like, I don't know, Carnival, wouldn't you want to get paid more if you know they're likely to go bankrupt? I would. So yeah, that's not enough. So let's look at that and see too. Here, if we look at the high yield index, the return has gone down. So I just wanted you guys to see that too. The high yield corporate index has gone down because people aren't getting paid enough return for the risk that they're taking. And so what does that look like here? So let's have this rate center up real quick so you can take a look. If you're looking at high yield, right? So high yield, and then we go to let's see. Let's pick out. So these are all investment grade, right? So if you look here, the average yield for like a 3-year, you look at the treasury on a 3-year, that's 3.2. And break-even inflation, pull that up. Let's type it in. So I think we went over break evens last time, but 5-year break even, all that tells you is that's the difference between the TIPS rate and the 5-year note, which tells you the market pricing of inflation. So 2.55%. If we take the 5-year break even and then we look at, let's say, a AA bond, for example, that spread is not that much, right? So 3.74 minus 2.55. So 1.19, that's the effective interest rate, inflation adjusted interest rate that you're getting. And is that worth the risk for a AAA bond? Well, it depends, or a AA bond, it depends. So let's go and look at some high yield. And pardon me, I had this ready on the high yield side, and this is not working exactly where I wanted it to. Bear with me. Okay, there we go. Okay, so this is what I wanted to say. So let's take a look at this. So we're at the 5-year, right? And we take our 2.5 off of that. So 5-year high yield. We take our 2.55 break even. So that gives us 5.97% inflation adjusted. Now, does it make sense for you to buy a bond for Boyd Gaming? Do you guys even know who this is? ATI, Safeway? These are high yield bonds with a rating that is below investment grade. Safeway, I know who that is. That is a grocery store. If you have been in the DC area, you know what that is. That is a grocery store. It's pretty decent, but a quick overview of this sheet here, what we're looking at is the yield or yield to maturity that you're gonna get. So the question you gotta ask yourself is, okay, if I buy this bond, I'm gonna have to pay the offer price, which is 7%. I take off my inflation, right? This is the rate that I'm gonna pay. I take my 2.55% inflation. So my inflation adjusted rate is 4.8% if I buy this. Now, does that make sense? Those are the investment decisions that you have to ask yourself. Does it make sense for you to give Safeway $1,000? So this the par value is $1,000. $1,000 for this bond. They have a B credit rating. Will you get your money back? Is there anything else that you can invest in that is safer than this, that would give you an equivalent rate of return? Well, I mentioned this, I think before, Series I bond, you can invest in those. They pay 9.62% right now. They're floating rate, but that's still better than an inflation adjusted 4.4%. So that's what you would be getting if you got this bond. The other thing that you want to look at too is the whether it is callable or not. And this bond is callable, and the yield to worst is 7. And so there's a difference between callable and non-callable. I'm not going to go too deep into all of that, but I wanted to show you guys this because I had an opinion that I put out, I think last month, about my preference of wanting spreads to widen a little more. They're not wide enough yet to warrant investment grade or even high yield without some more premium for me taking that risk. People do it all the time, but there are better uses of cash at this point for your portfolio unless you have to. So some people have an investment mandate where they have to invest in bonds, and so they, do these kind of things. But right now, there aren't any attractive opportunities for me yet. They're getting attractive though, and that's why I made the post. They're getting attractive enough to, if spreads widen, then I might be a bond purchaser for investment grade and high yield. There is a crux though, where I don't want them to get too wide, but spreads haven't blown out yet. And when I say blown out, when you see this or when you see this on high yield, then you know that there's some recessionary stuff going on. So here, if they creep up a little bit more on the spreads, then I'll be a buyer. If they creep up too much, then that means that the company might be insolvent and go into bankruptcy. So you got to remember that. You want to buy bonds, but you don't want to go too deep. You want to get rewarded, but you don't want the company to go bankrupt. So that's the fixed income side. When we flip to the equity side, any questions before I go to the equity side? I know I've been like going. So any questions before I hit the equities? No questions. Awesome. All right, so where are we with the equity market? Well, the equity market is calming down and things are becoming more investable. I think now positioning portfolios with a small mix of bonds, getting more into high quality stocks is becoming more attractive. The PE ratios have started to get closer to the average. So valuations are still elevated, but they're getting closer to long-term averages. Meaning if you invest now, the return that you get will not be muted based on your entry price. People are always like, buy stocks, stay invested, yada, yada, yada. But if you're buying too high, then it's going to take you significantly longer to get a higher return. So the Shiller PE ratio, I'm not sure everybody's familiar with that, but the Shiller PE ratio is a cyclically adjusted PE ratio. It is a 10-year average of inflation adjusted PEs to remove the impact of a negative earnings event. So what that means is in 2008, if you look up here, earnings were negative, and it's just simple division. If you have 100 divided by -1, then whatever that number is going to be ridiculously high, but it's artificial. So this adjusts for that so that you can look at PEs on a relative basis. And so here on a relative basis, we're still well above the average, but the CAPE or Shiller ratio, PE ratio is coming down. So we're moving in the right direction from that perspective. So things are becoming a lot more investable. Now, let's get to this VIX here. I wanted to show you guys this because it impacts how we need to look at the next year and what type of market we're in and how you should expect to see swings here or there because we're just way more volatile. So this was August 2019 prior to COVID. I skipped over 2020 because the VIX curve inverted, and it's been inverted since then. It started to get a little flatter, as evidenced by the term structure here, but it's still inverted. And so what does that mean? When you're looking at the VIX curve or the volatility curve, what this tells you is the expectation is that markets are volatile today, but you expect them to be less volatile in the future. So usually what the trade is, you do what's called a calendar trade, where you buy at the money, you sell, at the money options, and you buy out of the money options, or you could do the reverse. So when volatility is high, you sell and capture a little bit of that premium. You buy it here. This covers your theta. And then here, if volatility goes up, because your long options, you benefit if volatility goes up. But if you are positioned for, let's say, if you were short a put spread or something, you thought the market was going to go up, or you were short call spread, so you thought the market was going to go down, then you could get paid to hold that position because you're short theta here, you're long theta here, but you're short theta on the near-term option and you're long theta on the out of the money option in a later date. So that way you're theta neutral. So anyway, that's usually the trade, but right now people can't do that because volatility is expected to be higher in the future. So there's more uncertainty expected in the future. This is normal. This is not normal. This is where we're at before COVID. This is where we're at after COVID. This is the actual VIX today. So this is the futures curve here, this orange line, and the black line is the VIX contracts. So volatility is telling us that we have more volatile times ahead until the Fed is finished with its tightening cycle. And so that concludes that segment of it. And let's see, I said I was going to do equities, right? So let me hop over to that. So I have two charts. I wanted to show the one I used the last time we did. Well, I didn't like go through it, but I made a post about it. So this is the S&P. So this is sourced from the S&P company itself. This guy here, Howard at S&P Global. He puts this together, updates the all the information in this whole worksheet. And so what this tells us is the earnings within these different sectors for the S&P, the operating earnings, and their various percentages, percent contributions to the S&P. And then it tells us also the PEs of each of the various industries. But what am I looking at? What is going to help me make some decisions in terms of where I think the market's going to go? So when I looked at this last time, I wanted to know, okay, well, how many people have reported, first of all, so I can get an idea of the completeness of the report. So let's see, what is it? I think 90-something% had earnings completed at that time. At this time, 74%, excuse me, at that time had beat estimates. This time it's a little different. I highlighted this because I wanted to show what was in 2021 for operating margins, what was expected for 2022, which is less. That makes sense. Higher inflation, expected recession, companies making less money, makes sense. Next thing, total earnings higher than expected for 2023. 2022 higher than March, but not by much. This is where the price was at that time, May 19th. PE ratio was 17, forward PE was 15. So let's take a look at where we are today on the equity side. So the majority of earnings have been reported so far, over 90%. So we're almost fully complete as of August 2021, excuse me, 2022. And so what do we see here? We see a margin that's less than it was in May. Not by a whole lot, but less. And so that's exactly what I was kind of trying to hint at. And everybody and these commentators, they all talk about it. Okay, at some point, inflation is going to seep through. And we have to be realistic about the estimates that people are putting forth. So now what's happening is earnings estimates are being reduced by analysts. So like the analysts are reducing their estimates and all that. So now you have what we had a little bit for this quarter, but I'm sure is going to happen next quarter, where you have people beating estimates, but estimates are significantly lower. And so that's the shift that I've been waiting to start happening. And then you start seeing multiples compress. Now, see, you see this 16, if you have a higher price but lower earnings, then the multiple increases. Here we had a lower multiple because we had higher than expected earnings. Now the earnings are $8 less per share, but the price didn't come down enough. So if you just do the simple math, you look at it, expected earnings are $8 less, but the price is the same. Well, that doesn't make sense. The market has to come down. Now, that's just the math part. That's just the earnings part. People can say what they want. You had only 3 people beat earnings estimates greater than 75% this time, where you had 4 industries. You had a bunch of misses, and you didn't have as many misses this time because people reduced their earnings estimates. We need to see more of that. We need to see this earnings operating margin come down more. We need to see this come down even more as an estimate. The estimate is down. The actual is starting to come down. So we're starting to see what I'm expecting, but we're still not all the way there yet. So I still see more pain from an earnings perspective in the equity market. Any questions? All right, guys. Well, you've done good so far. Thank you for listening. We went over macro. We went over fixed income. We went over equities. And then we're going to bring it all together and then talk a little bit about some intermarket and cross-market, cross-asset analysis. And so what you see in front of you now is the USO, which is an oil ETF. It is the WTI crude oil ETF. It tracks the front month futures. UUP, that is a bullish dollar ETF that tracks the dollar index, because you can't actually trade it unless it's a futures contract. And then finally, we have GLD. We have AGG, which is the aggregate bond index, Bloomberg aggregate bond index. And then you have the SPY. Well, what do you see? Ignore these. Those are like chart lines. But can anybody tell me what they see when they look at this cross asset illustration here? All right, we got a question. All right, so Matthew Shannon said, are there sectors that may experience more significant reductions in price based on market conditions? Yes. So there is a awesome chart sent. Let's see, sector. And this is just a quick illustration. I like this. I don't know if you guys can see that that much or that easily, but usually this is the rotation depending on the market condition. And so when you hear people talk about going defensive or going cyclical or going this or that, depending on the economic cycle, you first have to identify the broad economic conditions. So usually I like to do like top-down analysis. However, once you figure out that we're going into sort of a recessionary dynamic, which is where we are now, that's when you want to start looking at individual stocks and try to pick winners within those industries. So right now we are in the late cycle here. We haven't gotten to a pure recession yet. So that's why financials are still doing okay. Real estate is starting to take a dump, and that's how you know that we're getting close. Consumer discretionary, you kind of already see it. Toyota, a few other companies, and this consumer discretionary, particular Target. So like they are like in the middle. So people have continued to go to Costco for a large part of their shopping. People that have money that can do bulk shopping, or they trade down to somewhere like Walmart and they keep going to Walmart. But people in the middle, when their resources get squeezed, particularly a Target customer, they just stop spending and they either go to Dollar Tree or Walmart or just the regular grocery store and stop buying other stuff. Technology, you see that as well. You see NVIDIA having challenges from a supply chain issue, supply chain dynamic, but also a softening in gaming, in part driven by the reduction in mining from Bitcoin and things of that nature. But you have a broad reduction in overall consumer spending on non-essential items. We've already seen this in materials. You do see some people starting to rotate. What I like to do, I'm a contrarian, so I'm buying financials, I'm buying real estate, I'm buying materials, some industrials, because as those prices go down and you start hitting those lows, if you start trying to rotate into them after everybody's done so, then you'll be buying highs. And I don't like to buy highs. So that's just my personal preference. But a lot of people are already here in the consumer staples. If you look at companies like Kimberly-Clark, toilet paper manufacturer, Kraft Heinz, folks like that, or companies like that, P&G, they've already run up. So if you are trying to buy them as a safe haven for a recession, then you're already too late. So the smart money started that shift early this year. Same thing with healthcare. So I'm not sure if that helps, but those are some of those sectors. These literally are the S&P sectors, and how that shift and that rotation would sort of happen as you go through. But most of those safe sectors are bid up already. You're welcome. Let's see. We were talking about the yeah. So back to the SPY. So what do you guys see when you look at this? Obviously, I had this on there. I don't want to take it off. I'll explain my reason in a second, but what do you guys see when you look at this? Oh, Luther, you're going to answer the question. You have your hands up. Okay.
Yeah, it looked like Luther was saying he had his hand up earlier and
I got it.
to take it down. I'm not sure what oh, that's the USD. Okay. So
these
what we're looking at is the dollar goes up, SPY will go down. Right now, the dollar is bouncing off what I'm looking at as a support level.
Yep.
So the dollar established that support. So if we bounce again here, then SPY should continue going down, kind of in that channel that's laid out. That's what I'm seeing.
Hey, you're not wrong. You're not wrong. So this is a cross asset approach to looking at the markets. It's not a full-on intermarket analysis, but it does kind of give you an idea of a properly constructed portfolio and how when the S&P hits you with that 16% decline from the beginning of the year, or maybe if you had some bonds in your portfolio that would give you 4% back. Or maybe if you had some gold in your portfolio, that'll give you 11% back. Or maybe if you had some long dollar positions, or maybe short other countries, that would give you even more of a lift to your portfolio. And then obviously is to get to some sort of stability within global economies. And so stable dollar, because what happens is if the dollar remains too high for too long, then that impacts the US's exports. We can import goods for cheaper, but it makes US goods more expensive to other countries. And so in terms of our level of exports, it starts to impact our GDP. And so, that's one component where, it's beneficial short term, but, stability wise, long term, relative purchasing power globally, the balance is going to shift back to something that's more normal. And that's kind of where the global economy is going. So see, somebody said the last time the Dixie did this was like 20 years ago. Yep, the SPY was down over 52. Yep, exactly. So if the dollar goes up again, they're saying in the market, yeah, Megan, I hope I pronounced it right, but yeah. I hate to be corny right now, but I don't know if you guys are familiar with The Rock, but I gotta say it, if you smell what The Rock is cooking, because I think Megan just did. But that's what I'm saying. And so just some things to be aware of as we're looking at all of this. So when you bring the dollar in, gold in, the VIX is elevated. The dollar is at all-time highs. The rates are increasing. And so we're just in an environment where even if we do have a soft landing, it's going to be a new normal with lower asset prices. And so housing market prices are going to come down as well. And so we'll see an overall resetting of US markets as well as global markets. And so it's bound to happen. And the magnitude, I'm not so sure, but I think that over time we're going to see some stability at lower equity price levels, higher bond rate levels, and lower dollar levels, and more balance globally. So like China, they're about to enter a recession, real estate driven recession. Europe more than likely is already in a recession. The UK, they experienced double-digit inflation. And so all these things seep over. And so they have imported, because remember, I was saying the dollar itself being as strong as it is, when we're selling products overseas, they're buying higher dollar value products. And so they're importing inflation from us. And that's how all of this stuff sort of happens. And that's kind of what happened with the global financial crisis. So like it happened in America, but then like it went all over the world, all because of us. Now, China, they're going to have a ripple impact from their to the global economy. I'm not sure exactly how severe it's going to be, but their recession is going to ripple through as well. Housing market will be the last shoe to drop. Yes, Luther. Yes, absolutely. It's happening. However, I don't think that it's going to be as severe as the 2008 crisis. And the reason is because everybody's not over leveraged yet. I think people remember 08. I think people are like, hey, I'm not buying anything right now. Prices are too high. And so they've not committed themselves to being over leveraged yet. It's not to say that people won't say, hey, you know what, prices are starting to come down a little bit. I'm getting that itch. I'm just gonna go ahead and buy. But the thing that's different is that the proximity to where everybody has recession on their mind right now. So people are like, you know what, maybe buying a house maybe isn't the right thing to do right now. So maybe I shouldn't do that. So people are thinking a lot different this time than they were before. So let's see. I'm trying to. So what I'm showing now is let's see. I have a bunch of different setups. So I'm trying to show you guys this this chart group. It may take a little while, but it's a chart group that I use for looking at the markets as a whole. It's a combination chart group, but it's also it's Thinkorswim, by the way. So it kind of gives you a bird's eye view. So we talked about the macro, the long-term investing, yada, 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 that whole deal. And then how you would use that from an investing perspective, short-term, medium-term. That's why it's important to watch the credit market. Exactly. Yeah. Luther said that's why it's important to watch the credit market. That is very, very true. Definitely want to watch the credit market. And that's why I was saying about the high yield stuff, because you know, if you're looking at high yield spreads and they blow out, and you're not paying attention, you could get caught off guard. That's what happened. One of the metrics that is not used as much now as it used to be is the TED spread. And the reason why it's not used as much as it used to be is because LIBOR, the London Interbank Offered Rate, that is the rate that banks used to charge each other for international deposits. And it got manipulated, and so people stopped using it. It's out of commission. They're gonna introduce and start using SOFR next year, which is that replacement. But yeah, the TED spread was the difference between LIBOR, which is a short-term intermarket bank rate, and the 3-month bill. And so when that expanded, that meant that international conditions were stretched out. And that blew out in 2008. And everybody could, everybody was like, oh my God, this is really a big deal. This is you could really tell that the market was in turmoil and that there was a crisis. I don't see anything remotely close to that happening now. I just don't see it yet. That's not to say that it won't happen or can't happen, but yeah, I don't see it yet. So what am I doing right now? I'm showing you guys a quick way on how I like to kind of look at stuff during the day. I had this prepared, but for whatever reason, when I saved it at the end of the day, it didn't close the way I was expecting it to. So it didn't save, or the setup didn't save. This is a 10-year note futures. If you look at all of these relationships, these are all on a 5-minute time frame. And if you were looking at this today, then you could see what was going on. And you could look at those relationships and use them together and make some decisions. And so all of these used in combination, now again, you don't have to do what I do or use my methods, but this is just how I like to look at things and make sense of what I'm seeing throughout the day and how things are working from a sort of global macro perspective. And they all kind of happen at the same time. So like if you were looking at this when the market took a dump, you'd be like, oh, well, that kind of made sense. But it's hard to tell without like fully appreciating all of the differences. So what you see here is you kind of see the VIX hitting a support level and just kind of hanging out there for like, what is this, 10:30 to like an hour and a half. And so everybody's like, oh, I don't know. Same thing, because remember they have inverse relationships. So IWM is the Russell, is a 5-minute chart. This is QQQ, same thing, same time frame. All of them move similar. So if you ever like wondering what's happening with the other, they all kind of move similarly. If you look, it's not really much difference, right? If you put all these stacked together, it's not really much difference. But if we look at the time frame and then we look at when the VIX pops, so let's say 12:15, and you see that first green candle. What do we see here? 12:15, we see a red candle and we see the Russell starting to cross on a 9-minute EMA, crossing a longer EMA and going below this VWAP here. That happened before it happened here with the SPY. So the Russell usually leads SPY. So if you're looking at all of this together, like you could literally stack them and then you see it all happening at the same time. Then over here, what do you see at 12:15? You see this? The dollar just took off. And like people are like, oh, well, we're flying to safety. That's what was happening. The VIX spiked, the dollar spiked, people were flying to safety because nobody was sure what was going to happen. Here, we were hitting up against a 50-day moving average on SPY and SPX and all that. They couldn't punch through, and all of this happened very quickly, but the relationships still hold. And so being aware of the relationships, you can look at some of this stuff and anticipate what the move would be. So if we go back here, 12:15, remember we were talking about interest rates and how interest rates go up, bond prices go down, interest rates go up, you usually see the dollar go up as well. Well, in this case, interest rates did not go up. Excuse me. Interest rates actually went down. So what was that telling you? We talked about flight to safety. People were afraid of holding positions over the Labor Day weekend. It's a long weekend, right? So like everybody's like, hey, you know what? I'm not sure what's going to happen. I'm not sure what's going on. Let me just get into my little safe treasuries. I'm gonna buy treasuries. So treasury prices went up, rates went down, the dollar went up, the euro went down, GBP went down. All these things happened very quickly. Nothing really happened in the oil market here. Excuse me, the gold market. But what it did, but it wasn't like crazy significant. Like it wasn't like a big pop. But you could see dollar went up, gold went down, but it wasn't a pop. And so if you're looking at volume here, you don't really see as much volume as you think you see on a big drop like that, even on a 5-minute, but it happened. But when you put all these things together, those are the kind of things that help to understand better the relationships between these different markets, why things are happening, and what to expect, how to anticipate some of these things before they happen, like why you are either in a trade and trying to figure out, well, should I get out of a trade? Should I stay in a trade? You know, if I'm in a trade, like if I was able to take this trade and I'm like, okay, well, should I get out of this trade? Well, from a technical perspective, I'm like, we're kind of getting close to VWAP, maybe I'll stay in. Oh, we're below VWAP, I'll definitely stay in. But let me look over here. Let me see what's happening with the dollar. If the dollar is spiking upward, I'm definitely staying in. If the VIX is spiking, I'm definitely staying in. And if I had been thinking about what's been going on from a macro perspective, I'm like, well, people are flying to safety and I can see the 10-year going up. I'm definitely going to stay in the trade because I understand why this stuff is going on. And I see gold taking a dump. Well, I understand why too. So bringing it all together, this is the USD lead SPY. Recently, yes. And that is, it depends on the direction too. So recently, the most recent experience has been strong dollar, weak SPY. Weak dollar, strong SPY. And that has to do with risk on, risk off, but also inflationary dynamics, because if the dollar is going up, then that means interest rates are generally going up. Today it was different. It was a flight to safety sort of situation and a risk off sentiment going into the longer weekend. So yeah. Any other questions? Awesome. Awesome. I appreciate you guys. I think that is it.